If you're investing for the long term, you've probably heard the same old names over and over again. VOO, VTI, maybe QQQ if you're feeling techie. But what if I told you there are other ETFs quietly outperforming, growing, and making people a lot of money? We're diving deep into 4 ETFs that might not make the headlines daily, but they could transform your portfolio over the next decade. Many investors get stuck buying broad-based ETFs like VOO for safety. They track the S&P 500 and move with the American economy. But the more everyone piles into the same ETF, the less alpha there is to capture. You need to find ETFs positioned for the future. The iShares Semiconductor ETF, ticker SOXX, is a must for long-term investors. Can you name a technological trend that doesn't depend on chips? AI, cloud computing, autonomous vehicles, all rely on silicon. SOX provides exposure to companies like NVIDIA, Broadcom, Intel, and Texas Instruments, critical players in innovation. Over the past 10 years, SOXX has returned over 400%, outperforming the S&P 500. We're entering the AI industrialization phase. Investing in SOXX during pullbacks could be smart. Semiconductors are the new oil. Buying SOX could be one of the best wealth plays of the decade. Let's balance tech exposure with something tangible, global, and essential. Enter the Global X U.S. Infrastructure Development ETF, ticker PAVE. The U.S. infrastructure bill isn't just about roads and bridges. It's about reshaping the entire industrial base. Consider clean energy grids, high-speed rail networks, and broadband expansion. All need essential materials and expertise. PAVE holds companies like Vulcan Materials, Caterpillar, and Nucor, profiting as the physical world modernizes. Infrastructure spending is a multi-decade commitment, providing stability even during recessions, protecting your returns. In the next 10 to 15 years, as global supply chains shift, the infrastructure sector may quietly compound while others chase trends. The iShares Global Clean Energy ETF, ticker ICLN, focuses on the rise of clean energy and resource transition. Clean energy is controversial. Some see it as the future, others call it overhyped. But many major economies target decarbonization by 2050. Trillions are being invested in renewable infrastructure, EV charging, grid storage, and hydrogen technology. ICLN captures a diverse range of companies, solar, wind, and energy storage innovators. The clean energy sector has seen volatility, but experienced investors see it as an opportunity for the next growth cycle. Investing in ICLN means diversification across the entire sustainability revolution, potentially leading to significant wealth transfers. The 4th ETF brings it all together in a way that most investors don't even consider. The Schwab U.S. Dividend Equity ETF, ticker SCHD. CHD is a silent compounding machine, focusing on high-quality U.S. companies with strong balance sheets and consistent dividend growth. Inside, you'll find giants like PepsiCo, Merck, Broadcom, and Home Depot. Businesses that can weather recessions and inflation. Reinvesting dividends turns small gains into exponential growth, accounting for over 40% of total stock market returns. For long-term investors, SCHD acts like the foundation stone of a resilient portfolio, compounding quietly and always paying you. These 4 ETFs together cover every angle of the modern wealth equation. SOXX gives you exposure to innovation and digital transformation. PAVE roots you in the physical rebuilding of economies. ICLN prepares you for the green revolution. CHD gives you dependable, compounding income that holds the portfolio steady through volatility. Together, they form the modern wealth core, a blend of growth, stability, and future positioning. Long-term investing is about understanding cycles. Each sector moves in waves. The investors who win are the ones who stay through the cycles, buying during pessimism and holding through the noise. ETFs like these reward the patient. They spread out risk across hundreds of holdings. Imagine investing $10,000 into each of these ETFs today. $40,000 total. Historically, the blended return from a portfolio like this averages around 10 to 12% per year. In 20 years, your $40,000 could grow to over $270,000 if left untouched, especially if you reinvest dividends. That's the magic of compounding. While these ETFs are US listed, their reach is global. SOX has chip makers in Taiwan, Korea, and Europe. ICLN in clean energy across continents. PAVE includes global suppliers, benefiting from US construction demand. This gives you worldwide growth exposure without currency or tax complications. No investment is risk-free. SOXX swings during downturns. ICLN struggles with rising rates, and PAVE could slow with project delays. The volatility creates buying opportunities. The long game is about using drops to accumulate more ownership when everyone else panics. Key's ETFs align with megatrends shaping the 21st century: technological sovereignty, infrastructure modernization, and energy transition. Governments can't reverse these trends. They're baked into how the world functions. These aren't speculative picks, they're structural plays. Dividend reinvestment plans allow automatic investments with earned dividends, turning your ETF portfolio into a self-feeding machine. You can start building your portfolio with small amounts. Invest $50 or $100. Consistency is key. Set a recurring investment schedule, automate it, and let dollar cost averaging handle market volatility to grow your wealth. Imagine 10 or 20 years from now, semiconductors will be in everything from agriculture to healthcare, shifting infrastructure toward automation and sustainability. Clean energy will dominate new power capacity additions. Dividend-paying companies will remain the backbone of financial resilience. The ETFs we discussed today will evolve, but remain aligned with the timeless themes that drive them. Think of wealth creation not as catching the next viral stock, but as building a foundation based on unstoppable trends. SOX, PAVE, ICLN, and SCHD are 4 megatrends that won't disappear. They're built on technology, industry, energy, and value. Start building your portfolio today. Don't wait for the perfect moment, because it doesn't exist. Consistency is key. Diversification is crucial. Even high-growth sectors need a spread across different themes and strategies. The iShares Global Clean Energy ETF, ICLN, is gaining traction, bundling exposure to companies leading the clean energy revolution. Governments are investing trillions into green infrastructure. The transition to renewables is inevitable. Tech has dominated for over a decade, but consider niche-focused ETFs like the ARK Innovation ETF. ARK bets on emerging technologies like AI and robotics. It requires patience and discipline for long-term success. The Vanguard Dividend Appreciation ETF, VIG is perfect for balancing growth and stability. High-quality dividend growers act as a stabilizing force during uncertain markets. These companies tend to weather recessions better and provide a steady income stream. Pairing VIG with high-growth ETFs like ARKK or ICLN gives your portfolio dual engines. Healthcare is another frontier you can't ignore with aging populations globally. The iShares Nasdaq Biotechnology ETF, IBB, offers exposure to groundbreaking medicine. Breakthrough drugs and patents drive massive value creation in biotech. Pairing IBB with dividend-focused ETFs protects against speculation risks. Financials are poised for growth as the Fed adjusts interest rates in 2025. Banks and fintech innovators are benefiting from higher yields on loans. The Financial Select Sector SPDR Fund XLF captures this theme. As rates rise, banks earn more on lending spreads. Fintech disruptors are scaling with digital-first strategies. Long-term investors may see significant upside as these firms adapt. Let's discuss global diversification, often overlooked in U.S.-centric portfolios. The Vanguard FTSE All-World ex-US ETF, VEU, offers broad exposure. Emerging markets like India and Southeast Asia are growing faster than mature economies. Including VEU spreads geopolitical and currency risk. Combining VEU with domestic growth ETFs leads to a balanced portfolio across continents. Strengthen your investment strategy today. With every sector going digital and threats multiplying, cybersecurity spending is skyrocketing. The ETFMG Prime Cybersecurity ETF, HACK, aggregates companies at the forefront of digital defense. It's a smaller sector compared to tech giants, but the growth potential is enormous. Demand for innovative security solutions grows exponentially. Holding HACK as a smaller portion of your portfolio can serve as a high-risk, high-reward complement to more stable ETFs. Inflationary pressures and geopolitical tensions have brought commodities back into focus. The SPDR Gold Shares ETF, GLD, offers a hedge against inflation. Gold isn't about explosive growth, but it's a wealth-preserving tool, especially during market volatility. A modest allocation to GLD acts as a portfolio stabilizer. Thematic ETFs targeting AI, robotics, or space exploration are gaining attention. ETFs like BOTS focus on companies producing industrial robots. As industries continue to automate, these companies will see massive revenue expansion. Combining BOTS with diversified ETFs positions your portfolio for multiple trends. Picking ETFs alone isn't enough. The key is allocation, reinvestment, and compounding. High-growth ETFs should make up a smaller but aggressive portion of your portfolio. Dividend and defensive ETFs form the backbone, while global and thematic ETFs act as accelerators. Reinvesting dividends and maintaining a long-term horizon truly differentiate average investors from extraordinary ones. ETFs generally have favorable tax structures, but some may incur withholding taxes or capital gains distributions. Strategically placing certain ETFs in tax-advantaged accounts can maximize returns. Combining different sectors creates a diversified portfolio that capitalizes on multiple trends. Patience is your greatest ally. Stick to a strategic plan for long-term success. The goal isn't just to pick hot ETFs. It's to build a balanced approach where growth potential and income stability work in concert. Combining high-growth innovation funds with dividend payers, international exposure, thematic opportunities, and safe havens like gold maximizes wealth creation while mitigating risk. Another important point is sector rotation. Different sectors outperform at different stages of the economic cycle. During rapid economic growth, technology and consumer discretionary ETFs often surge. In slower periods, defensive sectors like utilities and healthcare outperform. By strategically allocating across these sectors and rebalancing, you can capture upside while reducing downside risk, positioning your portfolio effectively. If this deep dive helped you see ETFs in a new light, hit like and subscribe for more investing insights. Share your thoughts on ETFs in the comments. Stay patient, stay disciplined, and let your money grow while you sleep.